Hello everyone, my name is Nirmal and I'm going to explain the concept of single entry system for 12th standard. Single entry is not an entry but a system where we have only single entry. Till 11th standard you must have studied the double entry system where we record two effects for every transaction where debit and credit side get balanced. That is the result of your trial balance, that is ultimately tallies. But in single entry there is only one side of transaction. So what happens is the vendor records only one part of transaction. All they record is debtors, creditors and cash, meaning they record the money they have to pay, the money they have to receive and the money they actually have received. So with this information only we have to prepare the final accounts or financial statements of single entry vendors or whatever you call it. Even sometimes partnership firms also maintain records on single entry basis. Sometimes not only the small firms but the bigger firms also lost their data due to something. They have only part of their record, so that is also considered under single entry system because we have only part of the transaction. So with this we can what do is create a double entry system. So we have to create second effect and we have to assume it and maintain the whole record, that is convert the whole single entry system into double entry system through which we can prepare financial statements, which is a bit difficult, right? Talking about difficulties, we have the simple one under which we maintain statement of affairs, not the actual affair but affairs of business. So what we do is we prepare a balance sheet at the opening of the year through which we can find out the opening capital, which is called opening statement of affairs, and we create another one at the closing of the year under which we find closing capital of the business, which is called closing statement of affairs. Simple, isn't it? But with this we have only opening and closing capitals of the business, but we need to find profit too, right? Because that is the part of final accounts. For that we prepare a statement of profit and loss in which we compare closing and opening capitals of business. For example, the opening capital was rupees 1 lakh and the closing capital is rupees 1.5 lakh. So what we can assume is the profit earned 50,000 in the business throughout the year. So for that we just reduce the opening capital from the closing capital. But what if the owner made some drawings or brought some additional capital? For that the amount that we get after reducing opening capital from the closing capital is just gross profit, and to get the net profit we have to adjust these things. Let us talk about drawings. What happens because of drawings is the balance in the closing capital gets reduced because of drawing. So we just add the amount of drawings in the gross profit to make it the original one. Because of drawings the profit is reduced, so we have to add back the drawings to make it more. Similarly, the additional capital brought in is not the actual amount earned in the business but an additional amount due to which the profit is overvalued, and to get the original amount of profit we have to reduce the additional capital brought in throughout the year. So we add the drawings and we reduce the additional capital. This is just the reverse of double entry system, but you need to understand the concept why we do this. And if any expense is not adjusted in the statement of affairs, we need to adjust in the statement of profit and loss, but we'll learn it in advanced level. This is just an overview of single entry system, what we do in single entry system. So that was pretty much it.